Yep.
Now, let's go on to some of the opportunities, because the opportunities when you have a downturn in the market are the key to increasing your overall net rate of return. And this is net of taxes, net of fees. And that's really what everybody wants, because they want to put as much in their pocket as possible when you do have growth. So let's talk about some of the opportunities. Now, you can't talk about opportunities without reviewing your liquidity, your income, and your investment strategy, because they all go hand in hand. This is more of a holistic look at the overall investment philosophy and process. And you can see here, we've got set up this diagram. Rocky put this together. I think it's a great chart, gives you a good visualization on what we're speaking to. And when you look at the 0 to 3 years, this is your cash, this is your conservative money, this is money that you can get to easily without creating problems in your investments when there's a down market. You go to the 3 to 7 year, that is more of a tactical value stocks, bonds, FIAs, fixed income annuities, and equity limit loss strategies. And this is going to give you income and growth at the same time. And it's it actually ends up refilling the conservative bucket. And then you go into the last bucket, which is your growth bucket. This is where you want most of your returns to be coming from. And this is also the area that most of our clients are going to have their Roth or tax-free money. Because obviously we want the tax-free money to grow the fastest. So taking in this concept, the issue right now is if people are taking income out of the market and the market is going down, are we not just accelerating that process, accelerating the loss? And the answer to that is yes. So you need to have a strategy to combat that. So let's talk about some of the strategies here. The first one really is complete a Roth conversion while the market is down. Step one, you convert the IRA to a Roth IRA from more conservative portfolios, bringing them to a more aggressive portfolio. So on the way back up, they're going to come back faster and obviously tax-free. Then you can look at the draw and let heal strategy. Everybody that was around during the COVID crisis and that correction we had at that point, most of our clients that were in the stock market taking money out of the market on a monthly basis, we employed the draw and let heal strategy. So what is the draw and let heal strategy for those that don't know? Well, the first step is you stop withdrawals from investments until the market rebounds. Because again, we want to stop the acceleration of that downturn. Number two, if you have life insurance, you're going to access the life insurance policy's cash value, or an alternative is to do a HELOC, a home equity line of credit, to replace your income. And keep in mind that the monies that come out of those two accounts are all tax-free. So you don't even need to draw as much money out as you were when you were pulling from a taxable account. So you do this all the while we're in the downturn in the market. Now, let's go to the next step, or the next strategy. This strategy is a reallocate risk up strategy. And this is where if your risk tolerance allows it, you shift from a lower risk profile portfolio to a higher risk profile portfolio. And again, while the market's down, if you make that switch, the higher risk portfolio will be more aggressive and it will ride up the upside of the market a lot faster than a conservative portfolio will.